Hi everyone, and welcome to this month's version of the Mortgage Mentor newsletter. Mortgages are a funny animal. Funny like a hyena funny. Nobody really likes hyenas. Nobody really likes their mortgage either. Both are not very well understood by the average person. Also, most people would be just as happy if they didn't have to have either. Now, this guy, you can probably do without. A mortgage, on the other hand, tends to be a little bit more necessary. A homeowner who takes the full amortization to pay off their mortgage will end up paying for their mortgage 2 times, or very nearly. Homes are pricey enough to begin with, so why don't we try to cut that bill down? Whenever people think about saving money on their mortgage, the first thing they think about is interest rate. And of course, that makes sense. Interest rate is the natural thing to gravitate to, and it's certainly possible to save money by refinancing. If you'd like to discover whether refinancing is right for you, feel free to give me a call, and I'll get together with you for a free, no commitment consultation. However, there are other ways to save than just by getting a lower rate. Did you know that by simply making payments on a bi-weekly accelerated basis rather than monthly, you will end up making the equivalent of an extra monthly payment every year? So what, you say? Well, any extra payments are taken directly off your principal. The extra payment is instant equity. In fact, making your payments in this way cuts the average 25-year, $300,000 mortgage down to 22 years, saving the homeowner in excess of $36,000 on a $300,000 mortgage. Making lump sum payments every year amounts to just about the same thing. For the average family, bi-weekly or weekly accelerated payments just makes it easier to find the money to make those extra payments. The effect of making lump sum payments can be staggering. One common method for finding the money to make extra payments is to put your tax return directly against your mortgage. Instead of spending your tax return on consumer goods, it's a great idea to pay down your mortgage with it. The average Canadian tax return of $1,400 paid against an average Canadian mortgage of $300,000 cuts a 25-year mortgage down to about 22 years and saves the homeowner about $30,000. The same thing can be done with company bonuses or any regularly expected extra cash. The general rule with large lump sum payments is that the earlier on in the life of the mortgage they can be made, the more impact they will have on your savings. Another method for saving money on your mortgage is to use a home equity line of credit. The thinking behind the idea is this: the average Canadian should be able to save money by taking their savings, their debts, their day-to-day banking, and rolling it all into a single account, reducing your interest paid on debts and maximizing the effect of your savings. While it takes a disciplined individual to make this work as it ought to, many people have found that the savings can be just staggering. If this sounds good to you, we should sit down and find out if an all-in-one type mortgage might be a good fit. When any combination of these is put to use, your interest savings can be just huge. I'll work with you to come up with a plan that fits your lifestyle and your needs. These are just a couple of the ways it's possible to save money on your mortgage. For more ideas, or if you have other mortgage-related questions, please feel free to give me a call at 778-908-9832. You can also email me at pcarmen@mortgagealliance.com. I look forward to hearing from you.